Used car prices are collapsing at an alarming rate in 2025, and the auto industry doesn't want you to know how bad it's getting. Prices are dropping faster than anyone predicted. Dealerships are drowning in unsold inventory, and repossessions are skyrocketing across the country. But why is this happening? And why now? The answer lies in a perfect storm of economic, financial, and supply chain factors that have built up over the last 5 years. From the artificially inflated demand during the pandemic to the crushing impact of rising interest rates, tightening credit standards, loan defaults, and waning consumer confidence, this isn't just a correction. It's a structural collapse. In this video, we'll break down exactly what's driving the crash, how it impacts buyers and sellers today, and why the road ahead may be even rougher than most experts are willing to admit. It all started back in 2020. When the pandemic hit, global supply chains were frozen, automakers halted production, and rental car companies liquidated their fleets to stay afloat. At the same time, stimulus money flooded the economy and millions of people suddenly had cash, but no access to new cars. This created unprecedented demand for used vehicles, driving prices to record highs. In 2021 and 2022, it wasn't uncommon to see used cars selling for more than their brand new equivalents. Dealers couldn't keep vehicles on the lot. Flippers made profits reselling trucks and SUVs. Cars, once a guaranteed depreciating asset, suddenly became speculative investments. The market was no longer functioning on fundamentals. It was running on emotion and scarcity. But while demand was being artificially pumped, supply remained constrained. Automakers, struggling with chip shortages and COVID-era restrictions, focused on high-margin models, leaving gaps in the affordable segment, and the financing industry responded with aggressive lending. 72-month, even 84-month loans became standard. Credit standards loosened and subprime lending soared. It was a house of cards, and it worked as long as rates stayed low and demand stayed high. Fast forward to late 2023 and into 2024, and that house of cards began to fall. The Federal Reserve, in response to soaring inflation, began an aggressive series of rate hikes that pushed interest rates for auto loans from historical lows to 7–10% within months. For the average consumer, that meant a car loan on a $25,000 used vehicle went from $380 a month to over $520 a month. A massive jump, especially as food, rent, and insurance costs were rising simultaneously. The result? Many consumers were priced out. Monthly payments were simply unaffordable. And it wasn't just about higher payments. Those who had bought during the pandemic bubble were now discovering their vehicles were worth far less than what they owed. More than 40% of trade-ins in early 2025 carried negative equity, meaning consumers were essentially trapped in their cars, unable to sell or trade without taking a financial hit. So what happens when millions of Americans are underwater on their auto loans? Repossessions rise. And that's exactly what we're seeing now. According to data from the Federal Reserve and Cox Automotive, auto loan delinquencies are hitting levels not seen since the aftermath of the 2008 financial crisis. In Q1 of 2025 alone, auto repossessions rose 26% year over year, with subprime repos up by over 35%. This isn't just an isolated issue. It's a systemic one. And it's not just hurting consumers. Dealerships are in trouble too. In 2021, dealers couldn't get enough cars. In 2025, they can't get rid of them. Used car inventory is sitting on lots for 60, 90, even 120 days. That's a death sentence in this business. The cost of floor planning, that is, the cost of borrowing money to hold vehicles, has increased dramatically due to higher interest rates. At the same time, foot traffic is down, conversions are down, and prices are falling, meaning gross profit per unit is shrinking. Many small and mid-sized dealers are holding on by a thread, trying to move inventory without taking major losses. Some are even liquidating at auction just to free up cash flow. And auctions aren't the safety valve they once were. Wholesale prices are crashing even faster than retail, meaning vehicles sold at auction are often bringing in less than the dealership paid just a few months ago. The Manheim Used Vehicle Value Index, one of the most watched metrics in the industry, is down sharply year over year, and analysts expect further declines through the end of 2025. It's a vicious cycle: falling prices, rising costs, weak consumer demand, and tightening credit. Speaking of credit, lenders are rapidly pulling back. Subprime loan approvals have dropped substantially, and banks are now requiring larger down payments, shorter loan terms, and stricter credit checks, even for prime borrowers. This credit contraction is having the same effect we saw in housing during 2007-2008. Demand is drying up because people simply can't qualify. And even for those who can, many are choosing not to buy. Why? Because people are watching prices drop month after month. In early 2025 alone, used vehicle prices have fallen over 11%, and industry insiders predict we could see an additional 10 to 15% slide by year-end. Consumers are waiting it out, expecting better deals in the future, and in many cases, they're right to do so. But this wait-and-see approach is also contributing to the slowdown. Dealerships are seeing fewer test drives, fewer leads, and far more ghosting from potential buyers. Combine that with a flood of off-lease vehicles returning to market and repos hitting auctions, and you have a massive oversupply problem. Meanwhile, fleet managers and corporate buyers are pulling back too. Many companies that overpaid during the pandemic are now scaling down, holding vehicles longer, or buying in bulk directly from auctions rather than dealers. So where does this all go? The signs suggest we're in for a multi-quarter correction, and possibly a multi-year shift in how the used car market functions. Prices will likely continue to fall through late 2025 and possibly into 2026, particularly in the $20,000, $40,000 segment, where financing pressures are highest. But the consequences won't just be financial. A shrinking used car market affects insurance companies, lenders, auction houses, repair shops, and even local economies where dealerships are major employers. For buyers, this could be an opportunity, if you're patient, prepared, and buying with cash or strong credit. But it's also a risky environment. If you buy too early, you may see the value of your car drop significantly within a few months. For sellers, especially those who financed a car between 2020 and 2022, this is a difficult moment. You may have to hold longer than expected or take a hit on trade-in value. And for investors or industry analysts, the collapse of the used car market may be a leading indicator of broader credit weakness and consumer fatigue. Here's what we know. Consumer auto loan balances have never been higher. Repossessions are climbing. Dealership profitability is falling. And lender appetite is shrinking. These are not isolated events. They are linked symptoms of an overheated market that's now in correction mode. And perhaps the most critical thing to understand is this. The used car market was never built to sustain the levels we saw in 2021 and 2022. It was a market driven by scarcity, fear, and easy money. And like all bubbles, it was only a matter of time before it burst. That time is now. If you're considering a purchase in the coming months, do your research, stay informed, and be ready to negotiate. Dealers are under pressure, and informed buyers will have leverage. And if you're a seller, consult market data before listing, and avoid panic selling. The collapse isn't over, and prices may continue to fall before we find a new normal. This isn't just about cars. It's about consumer behavior, credit cycles, and the fragility of markets that have been overstimulated by years of unsustainable growth. The used car crash of 2025 is not a fluke. It's a warning. And for those paying attention, it's a chance to act wisely in a time of chaos. Subscribe to Car Gurus for more expert insights, breakdowns, and unfiltered industry analysis that cuts through the noise.